Christopher, we spoke last time. I think I hosted the show. I think it was late last year in November, and but I'm not sure everybody out there has ever heard of you or know of your work. So, if you don't mind, could you give them a brief introduction of who you are?
Yeah, thank you. So my background is actually in military intelligence analysis, and I did spend the first part of my career working for the U.S. government in mapping. So I was creating maps, and I was working with the military very closely. I spent some time in Iraq and Afghanistan creating maps. So my background is not in financial analysis, but in the mid 2000s, what I realized is that there was an analog between creating maps for the military, which they must be very precise, and creating maps that allow us to see likely directions in the financial markets. So I take my background from a mapping standpoint, and I'm a fundamentalist at heart. In other words, when I was with the military, a huge part of my awakening, although I am a patriot and I love this country, a huge part of my awakening was when I was in Afghanistan and I saw a lot of the waste that was happening there as far as some of the problems with the directions that the wars were going. And I decided I no longer wanted to align myself with that, but that I wanted to do something where I thought I could really provide some more value to individuals who were trying to change their lives. So I am involved primarily in the precious metals, but I come at it from a technical standpoint. So I'm just saying I understand the fundamentals behind currency devaluation, behind debt, behind manipulation that occurs in the market, but I try to approach it from a level of what do we see on the charts to have the highest level of expectations.
Great, yeah, because in the end, it's obviously the price that matters most. So whether or not it's short or long term, it helps to have some feeling for what's going to happen, at least in the short and medium term. So I appreciate that. You did bring with you, it looks like 4 charts that we're going to use today in the presentation. I think let's just go ahead and start with that, I suppose.
Yeah, so let me just bring everyone up to date where we are for the closes here. As we're speaking, the markets are still open in the electronic access market, and we're looking at, for the price of gold in the spot market, 1291. That is down 0.5% for the week. And silver, we are looking at 1633, which is down a little bit over 0.5% for the week. So some slight weakness coming in here to the metals. And so hopefully we can pull these charts up that we're looking at, and we can have those displayed alongside the video so that listeners can know what I'm talking about here. But we have some long-term perspectives that we're looking at for the metals. And the takeaway that I would give at this point is that we are in the window. We are in the window where these markets must perform, where the precious metals, and I would say especially silver, must perform. We're in a consolidation at this point, and I would say there's a window of about 3 to 6 months here where this market needs to start showing itself, and these charts are going to show why, from a probable standpoint, why this is happening. So the first chart is we're looking at silver from 2001 through 2011, through the peak. We're talking a tenfold move there, a 1,000% move higher. And we're looking at every consolidation and every surge that happened in the price of silver from 2001 through the present. And so, for example, we can see the consolidation from late 2001 through mid 2003, a 23-month consolidation. And this is what silver tends to do. Silver tends to consolidate for anywhere from 15 months to just over 2 years. Really frustrate people, grind back and forth, and then boom, within a matter of 5 to 7 months or so, have major surges. So we saw that point, for example, in 2003 when the market surged then 76% in just 6 months, from the $5 an ounce range up to above $8 an ounce by early 2004. Then it consolidated for another 17 months. Boom, surged 123%. And people can see the historical cycles there that silver tends to go through. So what I've done is I've labeled the average consolidation through these 4 cycles that silver has had. The average consolidation of 21 months with an average surge following the consolidation of 118%, excuse me. So the takeaway here is that the work, if you will, the work in being a silver investor comes during these consolidations, and then the reward comes very quickly. And what silver tries to do is it tries to frustrate people out of the market so that the least number of people are participating when these major surges happen. So if we move along to the second chart, we're now looking at silver from the beginning of the present cycle, and there 2015 through the present. And we see a similar 6-month surge there, 6.5-month surge, 55% off the bottom in 2015, 1365 up to 2125. And we're showing that this market has basically consolidated now for 23 months. And so we are at the point where silver, if this is going to evolve into a bull market, sustained bull market, silver should be performing here within the next several months. So I've labeled the average consolidation from the previous chart and then the maximum consolidation. And we can see, so we're in this window where silver should be rounding up according to, and we have four sample sets here that we're referring to from the previous decade. So a fairly decent sample size. We're in the window where silver should be performing and matching that 2125 level and then surging significantly higher. And I would just say this to listeners that we're relying on statistics here from the past. The other possibility, if we do not see that, for example, by the end of the year, unfortunately, the odds would then favor that we are in a period of time similar to the early to mid 1990s, where silver basically did what it did in 2016. It surged very similarly in 1992, for example, and then it moved sideways for another 10 years. So I would just say these are the potentials based on the historical windows, and we're in that period of time now. We have to see silver perform.
Yeah, 10 years. I don't think anybody wants to wait 10 years. So just being flat out honest. I saw your last video that you put out on your iGold Advisor YouTube channel. It was entitled Silver Do or Die Time. And you did mention this scenario in your discussion. And, it's certainly something to consider if all of a sudden we had a downward price movement to, $13 or $14 or lower. That could seriously shake out a lot of people. So I completely understand what you're saying.
Yeah, and if I could add one more point to that, if that scenario does manifest, and so what I'm saying is I think we're going to know which scenario we are in by the end of this calendar year. I think we will. So we're about 7 months away from really having a firm idea of how this market's going to look for the next number of years. But within those possibilities, there's a huge difference. For example, if you're someone who is hoping to make a significant return on silver within the next 3 to 5 years, or you're in a lot of leveraged products, you're in the miners, et cetera, then that's going to be obviously a disappointing scenario for you, because it would just be showing us that is not going to be unfolding, at least within the next couple of years here, rounding out this decade. But there's a big difference, of course, if you are someone who you consider silver and gold to be your choice for putting away long-term savings, and you're hoping to really stack and accumulate within a low price range, that scenario could be not so bad. And I would actually put myself 50-50. There's half of me that would say I would love to just be stacking the bullion for the next 5 to 10 years and then have this really come to fruition in the next cycle. There's another part of me that would say, yeah, I would love to see $50 an ounce by late 2019. So
Yeah, I totally agree. And then you see that in comments in general. There's people who have either side, and both camps are out there. And, people, when they think of $13 silver, they think back up the truck. Others think, man, this is too long in the tooth. I might need to look elsewhere for something else to invest in.
Absolutely, yep.
Well, great. So should we slide to the next?
Yeah, that would be great. So here we are looking at the gold to silver ratio. For those unfamiliar or new to the precious metals, it's simply the number of ounces of silver required to buy 1 ounce of gold. And we're looking, this is a three-part chart, and I hope we can get this big enough so people can really see, but we're looking at the top, the gold to silver ratio from 2002 through the present. In the middle, we're looking at the price of gold, the corresponding price of gold. And the bottom, we're looking at the corresponding price of silver. And the key takeaway from the top chart, look at the red highlights, the red circles there at the top. What you can see is that from 2002 through the present, there is this multi-decade resistance zone in the ratio. So in other words, there's this level between 80 and 84 on the ratio where every time that the price of gold, every time that it has costed 80 ounces or more of silver to buy 1 ounce of gold, we have seen investors begin to make the swap, and they begin to sell gold to buy silver because it's relatively considered a better value at that point. And if you follow the arrows downward to look at the corresponding price of gold from those red circles, you can see how important these lows have been corresponding to those highs in the ratio. I mean, absolutely critical lows have formed in the sector over the last 16 years every time the ratio is at this multi-decade resistance zone. Look at the lows setting up in 2002, with silver at $4.50 an ounce and gold at $3.50. Look at the low, the next one in the crash of 2008. Look how that peak in the ratio corresponded exactly with the low in gold at $680 an ounce and the low at silver at just over $8.50. Same thing when we're looking at the one that's set up in late 2015. So within a couple months this time, gold got a bit of a head start, but silver really matched the bottom very importantly. And we're showing that this same level is appearing now in the gold to silver ratio. So this is why I say technically, and of course, these maps, these charts, if you will, these are showing what are happening to the fundamentals. People are buying and selling, commodities, currencies, precious metals for all these different reasons, and there's millions of people out there in the market. We can't possibly, part of technical analysis is recognizing my own limitations. So I can't possibly know what every fundamental is, because to claim that I could would be to claim that I know what each individual buyer and seller is separately thinking. And some of them are thinking we're entering World War III after Trump meets with the president of North Korea. And some are thinking, well, I just need to sell silver to pay some bills this month. So there's no way that I can know what every fundamental is. That's part of the key of technical analysis. But what we can see is the sum. We can see what the sum of all those investors are saying, because the one place that all the sum come together is the current price. Mm-hmm. So we're talking about this window shaping up here in the gold to silver ratio and the potential for what will be the fourth significant low in both prices of the metals shaping up within the next 6 months. And when we look at the last chart, this is a zoomed in. We're now looking at the same gold to silver ratio from 2002 to 2018. And so keep in mind how quickly, you can see the red call out on the left there, how quickly this ratio can drop from, for example, the 80s down to the 70s and then into the 60s. Within 6 months, silver can make up for years worth of lagging. And that's what we see when we study these patterns throughout history. Now, what we're looking at the present, you can see this blue call out. It's called the terminal rising wedge. This is a topping pattern. And sure enough, thus far, you can see by the green circles, thus far, this topping pattern has worked out in favor of silver. And I would just say that, so today is an example. We're seeing gold make a slight new low today for the week down to 1290, but we're seeing silver hold its recent range. Even down 5 cents today on silver, it's holding the recent range. So we're seeing that reflected in the gold to silver ratio. And just bring it back to the long-term gold to silver ratio chart. This is the potential. We are in that window now. And I won't be here 6 months from now saying, yeah, maybe it'll be this year, if we do not see the price action show up on the charts. I will have a different message 6 months from now, which will be something hopefully positive. But if it doesn't work out, we are going to be looking at a radically different strategy if you want to be successful and also stay sort of sane if we get that negative scenario working out here over the next 6 months.
Well, great, Christopher. I appreciate you coming on the show today. I wanted to suggest that viewers out there go and check out your YouTube channel. It's iGoldAdvisor is the name of the YouTube channel. I think I just looked, you have over 150 videos, and just so happened I was looking at what your highest ranked videos were, and I think the third one I opened up and just scrolled to the middle of the video, and you were showing a chart 2 years ago that it was basically a gold chart that spread over about 5 or 6 years, and it was 2 years old, the video itself. But what you showed in the middle of the video has pretty much played out for the gold price as far as where you thought it was headed. It was really amazing. I mean, it was spot on. It was uncanny. So this is why a lot of people enjoy your videos, and this is why they come and check out your analysis, because your track record is pretty spot on. So thanks so much for coming on this week. I wanted to give you the chance to tell viewers where they can find your work and all that jazz.
Thanks so much, James. I really appreciate the chance to come on, and all the best to all the listeners out there.